Good day, fellow investors. I just opened my email this morning and saw this news, and it summarizes pretty much what's going on with the market before today's Fed meeting. In general, we have some fundamentals that we need to discuss, and those are inflation going forward, expectations on the Fed rate and what it means if it's different. That, as Yellen said, leads to fiscal issues, and we can discuss investing going forward. Let's immediately start with the latest news that inflation ticked up in November, denting hopes that the Fed will lower rates soon. Now, with consumer prices going a little bit higher than anticipated, of course, if interest rates don't go lower as anticipated, that changes what is currently priced in the markets. And if we take a look at US consumer prices, we see this pickup in November, and inflation isn't at 2% but still at 3% on an annual basis. 2, okay, you might say there is not a big difference. However, it will depend on how the Fed reacts and what will they do. But I think the key here is not what they will do, is what they can, or to put it even in a better way, what they must do when it comes to interest rates. The thing is that now services, last year it was energy, but now services are increasing prices and keeping inflation up. However, let's take a fundamental look at services. If we look at the labor force, this is a log scale, so to show you the growth. Of course, we had the baby boom, and the labor force in the US was growing, a little bit slower in 1990s, 2000, but since 2006-7, this is pretty much flat. There is no growth anymore. Of course, we have this bump here, but it can slow down. And if you look at what's going on with the population, there is more and more older people, less and less workers, less and less people for services, which means there is higher demand for that. That pushes prices up. So that might also create an inflationary environment over the coming decade, and that's just one potential for inflation. And we can see here the services sector, how it is doing better, improving, but also costing more. And this also answers the question why inflation has moderated without rising unemployment, because there is less and less workers, which means that unemployment is not to rise, but costs might go higher on that inflation, and we have seen the recent tick up now. And if you exclude food and energy year over year, we are still at 5.5% according to Bloomberg. And if it ticks up further, 3, 4, 5, it's not far away. The Fed has this meeting as I'm filming this, and everyone expects that it will culminate with them holding interest rates steady again. Chair Jerome Powell will likely reiterate he and his colleagues want to see a more sustainable pullback in price growth toward their target before easing policy. However, it's easy to just discuss that, have big words. However, as Mike Tyson said, a plan is what you make until you get punched in the face. What happens if the Fed gets punched in the face? Here we have the projections for what the market is pricing in and what the Fed is thinking. Of course, the Fed has to stand its stance, and therefore the Fed's forecast is a little bit more stronger than the market's forecast. The market expects a steady decline in rates over 2024 to bottom up in July 2025 and be around 3%. The Fed expects things to go even lower over the long term, but stay stronger now. If we look a little bit at the news, despite the volatility in rates, many investors see yields as attractive given their still very high levels. Of course, when compared to 2% in the future. But that is on the conviction that the tightening cycle is likely over. And now the Fed can do a slow cut, a quick cut next year, and all are pretty good for bonds. Of course, bonds will do well if rates go down as the value of those long-term bonds go higher. However, we think we are in a slow growth, disinflationary environment. And that's what everyone thinks, but the reality is usually different than what people think. We have services, and then we have also 1.5 billion people entering the middle class over the next 10 years, which means there will be more demand globally, which means inflation for us older. Speaking of which, Yellen says no problem with inflation. She's paid to say that, so be careful there. Key to soft landing, no problems there. But on the question that higher rates will create issues, she says that those could imperil debt sustainability. Okay, so she has to answer a smart question. And the basis of the financial world as we are having it now, as we are living it now, is that interest rates now are just temporary, inflation is just temporary, and everything will return to normality next year. 2% Fed rate, 2% inflation, and we will forever live in this environment. To quote from The Big Short and Mark Twain, "It ain't what you don't know that gets you into trouble, is what you know for sure that just ain't so." And here we have the comment from Yellen that is very important for every one of us. So she doesn't believe that returning inflation to the Federal Reserve's 2% goal will be especially difficult. Usually the Fed, with its plans, has always nailed it. 2007, they nailed that there will be no crisis, no recession, no nothing, etc., etc., right? It's meaningfully coming down inflation. No reason why they couldn't hit their targets. We know that the Fed has never been correct on their projections, so why should we trust them now? And if it doesn't happen as they expect, then we have some other issues. Asked whether the US was on a sustainable fiscal path, Yellen repeated earlier comments that she doesn't see it as an urgent issue. Of course, not an urgent issue now. Now things look well, but maybe in 3 years when she will be, who knows where, elderly home, that will be an issue. She conceded that that picture could deteriorate if long-term interest rates remain elevated. So if inflation stays persistent, higher than expected, rates stay higher than expected for longer, then we could see a debt picture deterioration. As she says, if interest rates are substantially higher on a long-term basis than we previously projected, of course, that results in some extra stress on the fiscal outlook. And the best way to address that stress, as President Joe Biden has proposed, to raise the tax rate on corporations and high-income households to ramp up enforcement of existing tax laws. Yes, they're just going to tax corporations and the rich, right? What if it isn't enough? What if there is a recession? There is nothing to tax with corporations. Well, I think we are in for a tax hike if shit hits the fan. And that's something that few discuss because it's not urgent. But for me, as a long-term investor, 5-7 years from now, is something pretty urgent. And as she says here, our tax collections as consequence of the Tax Cuts and Jobs Act in 2017 have fallen to historically low levels, referring to the measures by President Trump. All of this leads me to the following conclusions. The market thinks 2% and 2% inflation will be there for eternity, free money practically, everybody happy, we continue to live in this environment of liquidity. However, there is huge debt. There is huge debt piling from the government, from anything that costs more if that doesn't happen. Plus, the whole world is developing. Maybe it won't be as they expected. What if we have long-term inflation, slow economic growth, and a bigger and bigger interest cost burden? What if that is the scenario? How will the Fed solve that? Higher taxes? Yes. Yeah, I'm going to raise taxes. Elect me for president. you get killed, not elected. The Fed, they can print more money, but if investors lose confidence in the money printing machine, then that's also a double-edged sword. And the thing is that 2% inflation and 2% Fed rate is not an expectation. It's the only hope for this financial environment. A different environment would lead to a disaster. And I'm investing for decades, and we have discussed this with Mark Spitznagel's overview for an apocalyptic financial crash going forward. Check that video. And if you want to invest long term, the non-urgent Fed things are urgent for you now. Prepare for higher taxes, prepare for lower stock market prices, perhaps inflation and higher stock market prices. In short, prepare for anything. To be prepared, stay tuned. Thanks for watching. I'll see you in the next video.